Hello and welcome to Sense Business YouTube channel. Today we will cover 3.5 income statement. Okay, so today's lesson's outcome is that we will understand what profit is and why it is important. We will understand how profit is made, and we will understand the difference between profit and cash, and then we will move on to understanding what income statement is and its main features of income statement, and we will understand statement of financial position, or also known as balance sheet. We will also understand the main elements of statement of financial position. Okay, so before I want to begin the lesson, I want to remind you that at the end of this presentation, there will be some questions I've prepared for you. So please make sure that you answer them because that is the only way that you can remember these tutorials. If you don't answer them, you're not gonna, and if you don't write them down, you're not gonna remember them. So please make sure that you answer them questions and try to remember them. Okay, so what is profit? So profit is a financial benefit that is realized when the amount of revenue gained from a business activity exceeds the expenses, so costs and tax needed to sustain the activity. Any profit that is gained goes to the business's owners, who may or may not decide to spend it on the business, who may decide to just buy a new car for themselves or buy a new house. So it is totally up to the owners to see what they want to do. So we can say that profit is the amount of money remaining after all the expenses of running the business are paid. So total revenue minus total expenses. I've put the formula here for you. You need to remember this formula for your exam. So to find your profit, the formula you will use is profit equals sales revenue take away cost is profit. You need to remember that for your exam. So why is profit important? Profit is one of the most important measurements in determining the health and success of a business. So that is why it is important. It is important because earning a profit is essential to a company's survival. A company that's not making any money is likely to go down the hill. So reward for shareholders, it's important because we can reward the shareholders. So profitable companies have cash available for dividends to shareholders. These are often paid on quarterly basis. If a company is not making money, they are not going to pay the shareholders, then shareholders are not going to be so happy. Compensation for owners and employees. So achieving and sustaining profitability are goals of every business owner. So that's why profit is important, because if owners have money and their business is making constantly profit, then they have money to expend and to give rewards to their employees. So that's why business is important. It's important because it has an impact on the stock prices. So the more profit your company is making, the more people are going to invest and buy shares on the stock market. Because if a company is falling in profit, then people are not going to invest and buy stock shares in that company. For example, Apple. If Apple continuously stops making profit, the shares will go down the hill. Nobody will buy any stock from them in the stock market. So money available to expand. So the profit is important because we have more money available for us to expand our organization. So expand operations. Earning a profit allows you to open other business locations, acquire another business, target other markets and expand your operations into foreign territory. So if your business wasn't making any money, then this would not be possible. So buy new equipment. So profit is important because we can buy new equipment when we are making profit. Ability to pay debtors, loans or mortgage. So if we have mortgage, loans, so if we are making profit, we can pay these back, and that is why profit is important. So hire more employees. A part of growing a small business includes hiring additional employees who can handle the growing responsibility within the company. And these are elements that suggest and proves that profit is a very important for any organization, because if we didn't pay attention to profit, we will not be able to achieve any of these. So now, importance of profit to a private sector business. So we need to understand what the importance of profit is to a private businesses. Okay, so profit is important for all businesses. You need to understand this, regardless in private or public sector. This is because businesses by nature is about providing a solution or a product that can solve a problem for a profit. That is the very reason of doing business. So it doesn't matter what sector you are in, profit still becomes the most important thing in the business. So profit is important to private sector big businesses because it is a source of finance. Businesses need profit to grow the business. So reward. Business owners want their business to profit so they can make money and buy that beautiful car they dream of, or the house, or the expend whatever their motives are. So that's why profit is important to private sector businesses, able to pay debts, loans or mortgages. So most private businesses will have mortgages on loans, and profit, when they are making profit, they are able to pay these back. So money available to expend, so they have money available to expend into different locations, countries, continents. They could go anywhere, and that's why Apple has become so successful and is everywhere, because they have profit, and the more profit they make, they invest into new things. For example, Apple Watch, they invest into that, and it boom and becomes number 1 product. And then when they make more profit, they introduce Apple iPad. So that is why profit is important, because if Apple hadn't make any profit from iPhones, they would not have been able to introduce a new product. So that is why profit is important for any business, regardless of what sector they are in. So how is profit made exactly? So profit arises when total sales exceed total costs for a period. So buying a service or a product at a lower price and selling it on at a higher price, and the difference is profit. So you might buy an iPhone for £100 and sell it for 150. The £50 is your profit. So profit is made by making something, or coming up with an idea, or in selling it on. Profit is basically getting rewarded for something that you have produced. So that's how profit is made. So a salesperson will use their selling skills to make profit, and their profit will be the commission that they get. So this is what profit is. So profit can be increased within an organization by reducing costs. So if a company's operational cost is £10,000, they could cut that to £8,000 and still manage to do the same job, and then that 2,000 that's left will be their profit. So sell more products. So if you're selling 100 products, try to sell 150 products. That will maximize your profits and increase it. So increase the price of the actual product or service. So if you are selling a phone, for example, for 50 quid, sell it for 60 quid. That will increase the price, and which will result in increase in the profit. But that is not always ideal. You need to remember what is the best option for your organization to go about this. So no discounting. Discounting can be the death of many businesses that don't realize how badly this destroys your margins. So discount is normally, as soon as I personally see a discounted thing, I think of it as cheap, or maybe not made of good product or not good quality, and that's why you become the trust just fails. So if somebody sees a product that's always constantly on discount, people are naturally gonna think that this product must be of not good quality. That's why it's constantly on discount and isn't on offer. So you need to be careful with this one. So do not do discounts unless you have run out of all other options. The best option is to finding cheaper suppliers, so you can increase profit by finding cheaper suppliers. It's not always the best idea in the world to stay with one single supplier. Go around, shop, see which other suppliers can offer you the same service for a cheaper price. So you need to shop around and look and get quotes for different suppliers to make sure that you're getting the best deal, and that will result in increased profit. So now then, we need to understand the difference between profit and cash, because a lot of my students think that profit and cash are same. So I've done the slide to make you aware that they are not. So cash is like air, profit is like food. So you need cash all the times because you need air all the time, but you can survive for a while without profit. So you could go a day or 2 days without the food. So that is what the difference is. Okay, so let's explain it a little bit more so you understand better. So cash refers to the amount of money currently or soon to be available. It is the money coming into the organization either from investors or direct business activity, and serves as resources to pay expenses. So that's what cash is. Cash is the lifeblood of all companies, and it is important for every business to understand and actively manage its cash. On the other hand, profit is the amount of money left over after all the expenses are paid. So cash is used for the daily activity or daily operation, to pay for the daily operation of a business, whereas profit is the money that's left at the end of the year, for example. So we know that the profit is not the same as cash. So we know that. So business can have profit but no cash to spend. So a loss making company can survive as long as it has cash. A profitable company cannot survive without cash. In business, cash is the king. I mean, it's not just business, cash is the king in everything. Even if you, in a real life, for example, if you want to live your day-to-day life, you need cash to buy your food, to buy your drink, to pay your rent, to pay your gas, electricity, these things. So cash is always the king. You need to remember that. Good stuff. So now we understand the difference between cash and profit. We are going to move on to 5.3.2, income statement. This is very straightforward. So make sure that if you feel tired, pause the video, go and have a little drink and then come back. If not, we'll carry on and learn this, because I will make sure that you get the highest grade possible. Okay, so we need to understand what income statement is. So income statement is also known as profit and loss statement. An income statement is a financial statement that reports a company's financial performance over a specific accounting period. For example, 1 year. So financial performance is assessed by giving a summary of how the business incurs its revenues and expenses through both operating and non-operating activities. So it also shows the net profit or loss incurred over a specific accounting period, and that is what income statement is. So we can also say there's another definition I've put here for you, is that income statement tells the company managers whether the business is making a profit or loss. Managers can also compare this year's income statement with last year's to see if there's difference in profits or losses. In addition, this can also be compared with other businesses in the same industry to see if you're making profit or not. Okay, the main features of income statements are revenue, gross profit, cost of sales, net profit, retained profit, operating expenses. You know what revenue is, don't you? It's selling price times quantity sold. We also know gross profit because we have covered it many times on previous videos. That's sales revenue take away cost of sales. Cost of sales is the cost involved in selling a product, so like promotion or handling, all that. So net profit is gross profit minus expenses. This is the actual profit after subtracting the business's operating expenses such as employee salaries and wages and so on. Retained profit we know is profit kept by the business for its own use. We know all these, so well done if you still remember it. If not, here was a quick recap for you to remember for your exam. So here's an example of what an income statement looks like. So this is a business consulting company, a picture I found on the internet. I will create a video, or I'll make a video where I will do a fully income statement just on this topic. So make sure you watch that video. So this is where the revenue goes, this is where the expenses go, and your income before tax and so on. All information is recorded here. Great stuff. So now we're going to move on to understand statement of financial position, also known as balance sheet. Okay, so the statement of financial position is another name for balance sheet. Just like I said earlier, it is one of the main financial statements, and it reports an entity's assets, liabilities, and the difference in their totals. So the amount reported on the statement of financial position are the amounts as of the final moment of an accounting period. Okay, I've done two definitions for you here for the balance sheet to make sure that you fully understand this to get that A star that you really deserve. Okay, so balance sheet is a financial statement that reports the assets, liabilities, and equity of a company on a given date. Remember this, yeah? In other words, it lists the resources, obligations, and ownership details of a company on a specific day. You can think of it like a snapshot of what the company looked like at a certain time in history. That is what balance sheet means. Okay, so the main elements of a statement of financial position or balance sheet are assets, liabilities, and equity. So these are the main elements of balance sheet. Okay, so let's just classify some of them. So this is a picture or a screenshot of a balance sheet that I found on the internet. So the first area is called assets. Assets are where assets go. So in this first area we put all the assets. So assets are things that have some market value. For example, land, building, property, computer equipment, cash in bank, cash on hand, cash advance, petty cash, and inventories. These are all your assets. Assets, so current assets are assets which are short-lived and which can convert into cash quickly to meet short-term liabilities are called current assets. So you need to remember that. I think I've covered that already, so you should know that without me even explaining it. So assets which have no physical existence and which cannot be seen, touched, or felt are called intangible assets. So your intangible assets also go under the assets. So you might be thinking, what are intangible assets since business? Okay, I will explain. Intangible things are things that you cannot touch or feel. So for example, company's website, the software that you buy, you cannot touch it, but you paid for the license of that software. For example, Microsoft Office, all businesses need to buy, nearly all businesses need to buy Microsoft Office for their businesses. So when they pay that money, they're paying it to get an intangible service. So they cannot see it or they cannot touch it. Or an insurance policy, that's also an intangible asset because you cannot see it, but you're paying for it, and it covers you if anything happens to your business. So assets which have physical existence and which can be seen, touched, or felt are called tangible assets. So this is your property, equipment, and things like that. Assets which have long life and which are bought for use for a long period of time are called fixed assets. So you need to remember that for your exam. Okay, so liability examples are bank loans, overdraft, interest payable, tax payable, account payable, noted payable, borrowing from parent company, intercompany account payable, salary payable are all your liabilities. So we have current or short-term liabilities. So the debts which are repayable within a short period of time are called current or short liabilities. You need to remember that. Okay, so now we are going to talk about the final section, which is equity. So equities are shares, capitals, retained earning or retained losses, revaluation gain, dividends payment. These are all your equities. So the difference between what your business equity basically means the difference between what your business is worth, so your assets, minus what you owe on it, your debts and liabilities. That's what equity means. So in other words, we can say that equity you have in a business is how much is actually yours as opposed to the banks and any other creditors if you were to sell it. Does that make sense? Good if it does. Okay, so we can say that balance sheet is a statement or a snapshot of assets, liabilities, and owner's equity capital on a particular date. Well done. So that's what basically balance sheet is. And now we'll understand the difference between what balance sheet is and what an income statement is, because a lot of my students struggle on that as well. So the difference between the balance sheet and income statement is that the balance sheet reports assets, liabilities, and equity, while the income statement reports revenue and expenses that net to a profit or loss. You need to remember that. That's quite pretty simple, and this is the simplest form I could put it for you, and that's what the difference is between the two. And that what brings us to end of this lesson. So very well done for listening and watching this video, but most of all, it is very important that you answer these questions. I've put 1, 2, 3, 4, 5, 6 questions for you. You need to, please, you need to answer these questions to help you remember, because if you don't write them down, you will not remember what you have just watched and listened to. It is important that you practice, so I want you to write down answers for each of these in the comment section below, and I will personally mark it for you. Okay, so the first question is, what is profit and why it is important? I want you to give me short, clear answers. So don't write lots, just short, clear answer. Is profit and cash same? Yes or no? You can you list 3 ways we can increase profit? We cover that. Is statement of financial position and balance sheet same thing? Yes or no? What is difference between balance sheet and income statement? List two main elements of balance sheet and income statement. Please make sure that you answer these questions because they are very important for you to remember things. If you don't answer them, you are very likely to not remember anything for your exam. Make sure that you watch the next video, for which the link will be around here. Also, if you want to win an iPhone, please make sure that you keep commenting, and I'll be selecting one random person and send them an iPhone. So thank you for watching. I will see you on next video. Take care for now.